Hi, my name is Stuart and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Let's get into today's Q&A episode. First question is from B&M. B&M, they're 48, 46, said they've been a little bit late starters to building wealth and has worked their way up into a family business, but prior to that, really just focused on lower income earners and focused on family. And so around 2018, so about 8 years ago, started to take saving and investing a bit more seriously. So here's a financial rundown. Household income's about 330, home's worth 1.65, no debt. Investment property on the Goldie worth 1.1 with 750 of debt. 440 in super, 120 in cash. The kids are financially independent, 21 and 19. And so their strategy is they'd like to retire in 4 to 5 years. And the strategy is to sell the family home and move into the investment property. So it's on the Gold Coast, as I said, and use the money from selling the family home to obviously repay the debt against the previous investment property, now home, of course. Top up super. I think they can get their balances to about 1.5, and then live off the money outside super first until they can then access super. And the question for me is, they'd like my thoughts on that strategy. So let's just go through the numbers. I'll just do it kind of out loud so I can get my head around them too. The home's worth 1.65. They want to retire in 4 to 5 years. Let's say the home's worth 2. The super is worth at the moment 440. Let's say they make maximum concessional contributions, where I reckon it's pretty likely. Let's say again, conservatively, the super's worth 600 in 4 to 5 years' time. A little bit of growth, but mostly contributions. Hopefully it's more than that, but let's just go off that. And so if we sell the home, we get 2, we pay 750 against the debt that is the previous investment property debt, now home. Leaves us 1.25. We're saying we're going to have 1.5 million inside super. So let's say we need to put 900 inside super, which then leaves me 350 left over, plus they've got cash, a little bit of cash as well, so another 120. That takes me to 470. 470 to fund what looks like could be almost 10 years. I don't understand the numbers, I guess is what I'm saying. Maybe they're banking on selling the home for a lot more than what it's worth today. Doesn't necessarily mean that it doesn't work. I'm just saying, well, maybe you wouldn't put as much inside super. But let me give you a bit of a rundown, actually, because in terms of how I would approach this back of the envelope kind of assessment, and this is really from doing this for 20 years or so forth. You start to, as everyone would know in their own profession, you start to build kind of rules of thumb in your own head, and you kind of get a sense of whether something's going to work or not. And that the same applies in financial advice as well. So we're going to retire in 4 to 5 years, 48 and 46. Let's go 47, midpoint. Let's say 5 years, we're going to retire at 52. 52 means that we're going to have maybe 40 odd years of retirement to fund. So you can use the present value formula in Excel. You could probably just ask ChatGPT or one of the large language models to work it out for you. But what you need to do is then work out, well, how much money do I need to retire at 54, 53, assuming I live for another 40 years, which I think's kind of what hopefully you live longer, and who knows? I guess with medical treatment, technology, education, all these sorts of things, maybe we should be even more conservative than that and go 45 or 50 years. But anyway, I'm just going to give you an example. And I want to spend $120,000 a year, and I don't want to run my balance to zero. Maybe I'll have a little bit of money left in the bank, let's say $200,000, although $200,000 is probably nothing in 40 years' time, by the way, but just to build a little bit of a buffer, and it's not that sensitive. It tells me I need $2.4 million. That's my starting balance in 4 or 5 years' time. Now, I assumed a return of 4% per annum, and that really is 4% plus inflation. So really, if we go inflation's 3, which it has been more recently, of course, it's been higher more recently, but, if you look at sort of average inflation, there's been periods of time in Australia where it's 2.5. I used to use 2.5, but I think 3 is probably the right number now. I don't want to get too caught up in, what's happened more recently, but again, let's be conservative. So then you're looking at a 7% return. I think that's about right. You you would think if you apply all the methodologies that I talk about over very long periods of time, you're going to earn more than 7%. But again, we want to be conservative with respect to that number. So we're going to need somewhere 2.4, 2.5 million, somewhere sort of in that vicinity for these clients' strategy to work. And if they sell their home for 2, as I said, repay the debt 750, that's 1.25. If we say that super is going to be worth 600,000 by then we're 1.85. We're a little bit shy of, and then got some cash, sorry. So let's call it 2. They're a little shy of their goal, which doesn't surprise me. I think it's pretty tight, their strategy or scenario. Now, of course, they might spend a little bit less. Returns could be a little bit higher. So, I'm not saying they can't retire in 4 to 5 years, but I think retiring in 4 to 5 years is a bit challenging, especially they're retiring early. So we've got another sort of 5 to 10 years of retirement to fund versus someone that works through to age 60. Now, what I don't know is what's going to happen to the business, whether there's any value in that business. As I said, they're training their son to take over. So will the business be handed over to the son, or will he have to pay for it? In which case, then you might crystallize some equity or capital from selling down the business. Also, the transition around the business, does that mean the income disappears? Because if I still own the business and someone else is working in it, well, obviously, hopefully I get some distributions or some sort of profit. So that might be where the moving sort of parts are in this strategy in terms of how do you transition into retirement, perhaps. So if B&M can, for example, continue to work at least in some capacity in the business to the extent that they earn enough income to pay for their living expenses, even if they're not saving, it gives their asset base a little bit more time to compound. And if the asset base is able to do that for another sort of 3 to 5 years, they're probably pretty close to being able to doing what they want to do. But what they're looking at trying to do now might be a little bit challenging, just as a back of the envelope sort of calculation. I guess my only other sort of feedback in their situation is if I had a client that was doing a downsizer strategy that had relatively low super, I don't think I'd lock away $1 million or something close to that insight into super when I was 53, 54. I think what I would actually do is I put some in there, but I'd keep a large sum outside of super. I'm happy to sort of lock it away closer to 60. And I acknowledge that obviously taxation outcomes might be superior inside super over that time as well, but you want to maintain some flexibility as well. I think they're sort of saying, let's put a lot of money inside super and take it up to 1.5 million, but I think I'd be a little bit more conservative with that. And the other thing too, I guess if you reduce living expenses to say 80,000, then they need 1.6, in which case they're there. So I guess the other compromise could be not changing retirement age, but changing how much we're spending in retirement. Now, 80,000, it's not a small amount of money, but it's a pretty relatively basic standard of living. I think, most people would regard it as, but could still be, it's not unachievable. So it's not going to allow for much in the way of holidays and travel, but, it depends on what your goals are. So that's my feedback, back of the envelope kind of calculation. But you really, if you're going to retire in that sort of level, you really need north of 2 in terms of investment assets, 2 million, to be in a situation where that's possible. Anyway, thanks B&M. Thanks for your question. Thanks for your lovely feedback on the podcast as well. Hopefully that gives you a few guardrails around planning out some of these things. Okay, next question is from Nitish. Nitish writes, question for you is regarding land tax exemption for 2 properties in New South Wales. I've recently bought a house and the settlement was done in October. This would have been October 25. I've moved into the house last week. My other PPOR is still vacant. Well, that's the previous home, and I've advertised it for let. As per New South Wales website, for land tax purposes, for 1 year you can have an exemption for 2 properties. However, it's a little unclear about the conditions. He goes on to sort of write about exemptions and so forth, but I'll just cut it off there. Most state revenue officers, they've all got different names in different states, but you know what I'm talking about, will have some exemptions. Typically the exemptions, and this is true in New South Wales, typically exemptions apply for things like changing over your home. So normally there's like a 6-month window if you own 2 properties just because you haven't sold your previous home yet. So in Nitesh's situation, Nitesh's situation, he's keeping the previous home and renting out. So that exemption is not going to apply to him. But if it was a situation where you had a home, you went and bought a new home and you moved into it, but you hadn't yet sold your previous home, or maybe it's on the market, you're trying to sell it, and 31 December clicks around because it's all about what property you hold at the end of the calendar year, you can still claim the exemption if you sell that within a 6-month period. There's other exemptions for adjoining lots. So, if you've got land on 2 titles, that can be a bit of a funny one. I know I've got a client in New South Wales where that's an issue. We have to do quite a bit of work around it. And the other one is when you are renovating. So if you move out of your home, there's some land tax concessions around renovating or buying a home, for instance, that's not occupiable. So if it's so dilapidated, you can't actually occupy it, but you're going to rebuild on that property. But the interesting thing is you just need to get some advice, I think, on these sorts of things. So if you think you fall within some of those general exemptions, then it's possible they're there. Just speak directly to the state revenue office or whatever it's called in your state. But for people that have properties that have kind of unique attributes, always good to get some advice around these aspects to make sure you're not, you don't expectedly get a land tax bill or some other state sort of taxation in the mail unexpectedly. So, Nitesh, no way of getting around this, at least based on what you've told me. Unfortunately, one of those properties is going to attract land tax. Okay, next question is from Chris. Chris writes, my wife and I keep our finances completely separate. She's 14 years younger than I am. I'm 55 years of age. I want to retire in 3 years' time when I'm 58, whilst she's still working. Our home in Berwick, that's in Melbourne, is worth 900 with around 200,000 of debt against it. My super's worth 560. Shares in my own name are worth 400. Margin loan of 65,000. I'm about to sell a rental property in Apollo Bay. He's given some details. Essentially, he's going to walk away with after tax about $300,000. And that's what his question relates to. What should I do with the $300,000? So we're retiring at 58, so 2 years before we can access super. We've got 400 outside super. What should I do with it? I think I put it into super. Oh, sorry, he's asked, should I repay the home loan? Well, if you keep your finances separately, then my question would be, what proportion of that 200,000 home loan is your share? Because I've come across this situation before where a couple likes to keep their finances separate, and quite often you'll have, and particularly the older person will have less of a debt against the home than the younger person. So I don't know what the answer to that question is, but I guess to the extent that that debt relates to you, yes, I would repay it at that particular time. You don't really, the goal is to try and not take any non-tax deductible debt into retirement, because then you're interest rate sensitive. It's not a lot of debt in the scheme of things, but if interest rates go up, it does have an impact to your ability to live. So let's say half of that debt is related to you, Chris. You'd take 100,000 and put it against the home loan, and then you don't need to worry about the rest of the home loan. Your wife will look after that. She's got another 14 years to work, beyond what you work. So I'm sure that she'll be able to do that. Well, I'm not sure. I assume she's able to do that. And then the 200, I would say if you're 58, you got 400,000 outside super, I would put the 200 into super. And the reason that I would do that is that you're already going to have a little bit of a challenge, perhaps, of getting that 400 into super, not because of the contribution caps, but because of capital gains tax. I assume that there's some hopefully unrealized gains in that portfolio. So you don't want to accumulate any more capital gains liabilities outside super. So put the 200 into super. That'll take your super to, in today's dollars, 760. In 3 years' time, hopefully it's a little bit higher than that, maybe 800,000 or 900,000, which is a pretty healthy super balance. You can then live off the 400,000 in your personal name. You've got a margin loan of $65,000 there. I mean, it just depends on how you're invested. So if you invested in a way that you feel pretty confident about future returns, you might leave that 65,000. That's not too much really internal gearing to, take into retirement, and then maybe just progressively sell down that portfolio. And then in a couple of years' time, the goal would be, how much can I move into super? So the goal would then hopefully, putting aside taxation consequences, you take that full 400 and put it into super. I mean, you've got to deal with the concessional contribution cap, so you might have to, do that over a period of time. But the reality is you're going to have to think about capital gains tax. So it might be, sell down 50,000 in that portfolio each year for the next 8 years, make a concessional contribution to offset the capital gains tax liability, and then the remainder of the amount goes as a non-concessional contribution. And within 8 years or even shorter, you'll be able to probably get that full portfolio into super without paying too much tax. That stage, you're going to have, well north of $1 million likely inside super. And I'd say you're off to the races in terms of enjoying retirement. So No, thanks for your question, Chris. I hope my answer was useful. Okay, next question is from Luke. Should say I'm this is the 5th of December 25, so I am running a bit behind, but actually we didn't get as many questions in February. Only got 10, 27 in January, 22 in March, or at least so far this month. So I think I'll be able to catch up a little bit over the next weeks, and I might rope Campbell into doing a couple as well. So anyway, next question is from Luke. Luke writes, enjoy your balanced responses listening as I walk the dogs. I've both your books on the shelf at home, which I value. My pre-question, how long do you spend preparing answers for these questions and how much is off the cuff? So I read the question and then I might pause for a little bit, have a think about it, and then I'll give you my answer. So pretty off the cuff, but let's not forget I've been doing this for nearly 25 years. So, if I can't put myself in a position where I can come up with a relatively decent answer straight away, then, I've got to be thinking, what have I been doing for the last 25 years? But the concepts, Morgan Housel, who wrote Psychology of Investing, which I think is a great book, and I really enjoy, he's a journalist, and I don't say that in a way to be derogatory, but I'm a practitioner, he's a journalist. We're going to have different viewpoints they're going to come from different sort of experiences, I guess. Talking and advising clients, I think you get a different experience to being a journalist. Notwithstanding that, I think he's great. I love how he writes, and I love what he writes, most of what he writes. And he made the comment, I remember listening to him a long time ago, he made the comment that I don't really talk about 6 or 7 different things. I just say them in different ways. And it's kind of true. There's only, I rewrote Investopoly, now Wealth by Design, and I stuck with the 8 rules. They don't change. It's just the application changes. I get that it's difficult for people, that aren't financial planners to pick up that nuance, but really the rules don't change that much. That's why it's not easy to do it off the cuff. It takes a bit of mental energy, but that's why, I'm able to be in that situation. Okay, anyway, Luke continues for his real question, if you like. I got a question about our ability to retire early. My husband and I are in our mid-40s living in Sydney. We have equal incomes office jobs, equal supers and assets in shared accounts. So it looks like we've got a perfect balance of taxation liabilities there. We each earn $180,000 a year. We're able to save around 40-50% of our take-home pay, which has been about $100,000 a year for the last 6 years, although we expect that to be slashed in half by 2027 when our 2 primary school age children go to private school. Current savings go about 2/3 into shares and 1/3 into the offset. For assets, the home is worth 2.8 with 800,000 in debt. We have $1 million in shares, all 3 low cost index funds, 50 US, 30 Australian, 15 Europe, and 5% Asia. I like the nature of the share market, being able to drip feed money in each month. I know 100% shares is high risk, but I see 200,000 offset as low risk compared to bonds and so forth. So I don't think shares are high risk. I actually think not investing in shares is high risk. And the reason I say that is you invest in the share market over very long periods of time, you're going to get 10%, or at least history tells us. It's been about 10% returns. I mean, if you invest in other asset classes that might have lower volatility, your returns are going to be lower too. And so I think earning lower returns is risky because you get further away from your goal. I know Luke probably didn't mean that necessarily, but I think, I've written about this before, being 100% growth in growth assets, that's where it all lives. So I think it's much easier to become comfortable with volatility and therefore maximize returns over your life than try and I know it sounds a bit stupid, design the asset allocation to suit my preferences, because my preferences are the result of my lack of education. I might not really understand what I'm investing in. Perceived risk is different to actual risk, and it could be shaped by my own experiences. So, if my parents invested in the share market and lost a lot of money when I was young, I might have experienced the stress that caused in that family, and then I take those lived experiences and reflect them in my own decisions in life. So, I know it's kind of a funny thing to say, but I think we're actually better off when we're thinking about money. We need to really think about what's my own psychology and to what extent should I let that influence my decisions, because you just then repeating the same mistakes that previous generations if it's been a family event issue that sort of shaped those feelings around money. So I don't think 100% shares are risky, as I said. I think for people that are looking to build wealth, that's exactly where it should be. The other interesting observation that I make here is you've got a home loan net debt of about 800,000 against a $2.8 million asset. Isn't it? It's almost genetic lottery being born in Sydney. Like if you're in a market, it's funny, there's a bit of a learning there because, if you're in Sydney and you're talking to someone in their 20s and 30s, they go, no, it's not, Stuart. It's so expensive to buy. It's a real challenge. But then we go and buy something in a market that we've got very restricted supply because, of course, just it's landlocked by national parks and water. And so we're forced to invest more sooner. We're forced to take on higher debt sooner. But actually, the reality is that it's a great outcome for most people in the long run. They end up building a lot of wealth just from their family home. Can you apply that same learning in other markets? Of course you can. And that's why I always talk about, sometimes your home can be one of your best investments, not only financially, but also impact on lifestyle as well. Anyway, I'm getting distracted. So anyway, Luke goes on to say, like most other people that write in, we have no investment properties or family trust. Our superannuation is about $400,000 each in low-cost, high-growth funds. Our current plan is to work another 5 to 7 years, in which time we hope that the shares would have risen to about $2 million, assuming 7% growth and additional contributions. Our living expenses are about $100,000, rising to $160,000 for school fees and about $50,000 for the home loan. Do you have any views on the initial plan over the next 5 to 7 years? What watch-outs or considerations do you have for bridging the gap of 8 to 10 year period until we can access super, which I estimate would be around $1 million each? That is the super, about $1 million each. Our retirement doesn't need to be black and white. Either of us may pick up a small income either because of mental stimulation or work relationships. I know you talk about generational wealth, especially with property, but I'm nervous to go down that path knowing that we may not have the income midway through the home loan term to service the debt on top of the tenant's rent. Many thanks for your thoughts. Okay, Luke, well, you've got a really strong capacity to be able to save and invest. I mean, that's a massive positive to begin with. And, if we come across clients with a massive ability to, make contributions towards investment, then that's the easy bit. Most of the hard work's done, right? So good on you for, managing cash flow well, practicing delayed gratification, because, you could go and spend that money on something else, and investing and saving hard. So that's my first kind of observation, if you like. You get to $2 million of shares. I mean, you don't have a family trust. But the question would be, if you had a family trust, would there be anyone else to distribute to? Now, yes, in the kids in the future, but no, that's not going to give you any sort of tax benefits maybe over the next 10 years. And that means that if you didn't have anyone else to distribute to, because obviously you're very close to the highest marginal tax rate, and then with dividend income, you're definitely in the highest tax rate, then I don't think I'm too worried about having a family trust, and having an even split between you and your husband is completely fine. I don't have a problem with you not having any investment property either. This is the thing, right? When we do some projections and someone with a very strong surplus cash flow, let's put the private school fees to the side for a second, but someone with a very strong surplus cash flow, my view is the core strategy should be the lowest risk strategy, get you there. We can then introduce a little bit more risk or a little bit more aggressiveness, I guess, with the guise of saying, well, maybe if we go a little bit harder now, you can retire sooner. So we might do that. But in this situation, when we want to retire in 5 to 7 years, taking on debt at this stage, more debt, would get you further away from that goal, not closer to it. It's just not a long enough time horizon for us to be able to use that debt to our advantage. Remember, gearing and compounding capital growth, to really generate huge dollar value gains, you really need to be able to hold that asset for 20 years. The longer you hold, the better, but 5 to 7 is just not going to move the dial from a capital growth perspective. So it's not going to change your asset base that much. But what it will do is retard your ability to, make choices in terms of reducing working hours or stopping working. So I actually think in your situation, not having investment property is putting you in a stronger position. Then you've got 8 to 10 years of living off the share portfolio. and then into super. So you're going to be okay. I think 2 million, 4 million, you're going to have a perpetual portfolio there, just broadly, kind of rough numbers. It's then just about not being too conservative, I think. I think investing well and not being too conservative. I mean, Campbell recorded an episode around the Australian share market, episode 397, that was back in February. And the real theme around that was, what's the attraction to the Australian share market? And would we invest in the Australian share market if we were living anywhere else in the world, like if we weren't Australians? And the answer would be, well, it's mostly materials and financials. You got Rio and BHP, the two big miners. If they have a good year, the market has a good year. And then you've got the banks and throw in sort of Telstra and CSL and a few others. They're the ones that if they have a good year, the index has a good year. But neither of those sectors really stand out that look like they're going to provide great opportunities, and the starting valuation isn't particularly attractive. So I think your key success factor here is that you're at $1 million, right? And just mathematically, your returns start to become way more important than your capital contributions. In the earlier years, you would know, of course, that if you were investing $100,000 a year, it's your contributions that were moving the dial. Your contributions really probably accounted for 80% or more of the growth in your balance rather than returns. Well, now you're at $1 million, and certainly as you get closer to two, your contributions will start to become relatively immaterial. And I'm not saying because you've got school fees coming up, you're going to reduce your investing to $50,000 a year rather than $100,000. But, that's the key success factor here. So you've got another 5 to 7 years of working and investing, and then you've got another 8 to 10 years of then living off those investments. So your investment time horizon is really, 13 to 17 years, somewhere in that vicinity. So you want to invest in a way over that. And it's kind of a perfect time horizon, I should say, by the way, because what you can do then is look at the markets, the indexes, the strategies, and think about, well, which ones are going to be, when I look back in, say, 2036, which ones are going to be the standout markets over that 10-year period? That's the best approach for you to take. That's not the Australian market. I don't think that's my view. You got 15% in Europe and 50% in the US. I think the asset allocation is all skew-if. I'd actually rather have 50% in Europe and 15% in the US. You got 5% in Asia, most Asian markets, emerging markets. I'd actually rather have 50% in Europe and 50% in emerging markets. I mean, if you speak to any other financial advisor out there, they would say you'd be an idiot to put 50% of your portfolio in emerging markets. And the reason for that is that emerging markets tend to have slightly higher volatility. So actually, I think the risk in emerging markets is somewhat overstated because their volatility tends to be higher, maybe by 2 or 3%, which means the swings and roundabouts are more volatile. But at the moment, you look at some emerging market indexes, they're trading on 11, 12, 13 times forward PE ratios. That's really, really cheap. I mean, that's super cheap. And there's an investor out there. I remember listening to an investor and he said, where are you going to get the growth from? Because developed economies grow at sort of 2 or 3% per annum. It's emerging markets that where the growth is at. And I guess, if you look at countries like India and China, they've got, huge populations of billions of people, and that's where businesses can get massive leverage, right? As opposed to Australia with 27 million people, big deal. Even if you have a product or even you think about books, selling books, you have a popular book in Australia, it's nothing in terms of sales. You have a popular book in the US, it's a big deal. And imagine if you had a popular book in China or India, it's even a bigger deal. So please don't listen to this explanation or answer and then turn around tomorrow and put 50% of your balance into emerging markets. I'm not saying that. If you had a look at my portfolios, for instance, I've got a lot more in emerging markets than would be deemed sensible. And when I say deemed sensible, there's this general approach to asset allocation, which Campbell tested. The Campbell's podcast was really important. I don't know if people that aren't in the financial advising space recognize it, but it really bucks conventional wisdom. Let's drop the wisdom because I don't think there's a lot of wisdom behind it. I don't think there's a lot of wisdom behind how portfolios asset allocation is constructed in Australia. There's no evidence behind it. So, if I was looking at Luke's situation, if we got the asset allocation and really improved it, the next sort of 10 to 20 years, which is going to be his important sort of window in terms of returns, could really move the dial. That's his key success factor here, I think. Now, to help you, I'm planning to record an episode on the 22nd of April about how to construct an ETF portfolio. So if you're listening to this, don't do anything just yet. Maybe wait until close to the end of April and I can share that episode with you. But thanks, Luke. Thanks for writing in, and hopefully that answer helps. Okay, I'm going to squeeze one more question here from James. I emailed you a question earlier this year around June, but it was never answered. But that's okay because a lot's changed since then. I'd like to change my question. Would love your feedback on my financial position as now. So sorry, James, for missing your question, but we changed the process, so none should get lost anymore. Anyway, James writes, I'm currently in Brisbane, but just bought a house in Sydney, and I'll move back there in the near future in 1 to 2 years. Obviously, James likes the rain because that's all you get in Sydney. But anyway, he gave me the address. I won't read out the address. I was actually quite happy with this purchase. I thought I could only afford a townhouse in this area. Although it resides on a busy-ish road, I'm grateful that I could purchase in this area as it has a great school catchment for my future children. I'm 28 years old and borrowed a substantial amount of money, 1.575, nearly 1.6 million, to afford the property. I'm now getting indigestion, as you've mentioned multiple times in your podcast. I will be renting out for a couple of months as I cannot afford the repayments on my salary. Even after renting out, I find it a bit difficult as I won't be having much surplus money at all. I will be renting a smaller apartment with my partner until I'm ready to move back into the house, hopefully to begin a family within the next 5 years. I feel like I've made the best decision I could in terms of purchasing and maxing out my borrowing power. Although I'm feeling quite sick at the moment with the money involved with mortgage payments and house maintenance, what would you do in my shoes? I'm thinking about the best steps from here and how I could build my wealth further, but I'm quite tied down with this purchase. Would you kindly evaluate the purchase, see if there are any other tips that you could adopt to in the future to improve my position? Okay, so James, well, congratulations on getting a property in the area that you really wanted to be in. That's fantastic. I've got a couple of comments to share, and actually I'm recording this answer on the 24th of March. Last night, Campbell and I recorded a YouTube live Q&A episode, and in there, last night I was saying that sometimes, we talk about planning and having a good plan, a robust plan, so that you start with the end in mind and how you're going to fund retirement, those sorts of things. I guess in James's situation, that's difficult, sometimes really difficult to do. He's only 28. How can he really see how the next 30 years of his life's going to play out? It's really challenging. I mean, it's challenging probably to do it at your 40s, let alone in your 20s. So in that situation, really the best thing to do is still focus on long-term outcomes. That's one of the rules in Investopoly, the book, which is really play the long game, make those long-term decisions, which James has done, which is buy well, buy in a suburb that's got some positive attributes. For example, school zones, they help with in terms of capital growth. Max out your borrowing capacity now at 28. I don't know what occupation James is in, but I'd imagine over the coming years his income's going to rise. And, 35, he might look back and go, well, I wish I could have spent more when I was 28. I would have got myself a better quality property. So, the indigestion that you feel isn't going to last forever. The things change, things improve generally. Not always, let's not bank on that, but generally they improve and get a little bit easier. And of course, we're going through at the moment, a tighter sort of interest rate sort of cycle, which is challenging, very challenging, but it's almost like a rite of passage, I think, to some degree, to go through a period that, you're very heavily leveraged, that you've got to make, significant compromises in terms of lifestyle. You don't have any other money to spend. You've got to stay at home. You can't go out to dinners and these sorts of things. Well, we've all been there. And the thing is that in life, people that are prepared to make significant, unusual or above average sacrifices are the ones that generally reap the above average rewards. Buying a property or investing in property, that it's never been easy per se. It's always been challenges and there's always things that, you need to forego in order to do it. But people are willing to do that hard work, reap the rewards in the long run. So I don't think you need to, so I guess what I'm saying is I don't think you need to worry so much about, and this is going to sound strange, given this is what all I talk about in the podcast, but I don't think you need to worry about what is your strategy moving forward. You just need to survive the next 5 years. And knowing that if you survive the next 5 years, if you get through it, chances are you're going to start building equity in the property. Your income's probably going to rise. Hopefully interest rates over that time also come down a little bit. Your cash flow situation is going to improve. I've seen it many, many times before, James, like in terms of people, young people buying into a property, being very high leveraged and, it over time getting more and more affordable. And then in 5 years' time, for instance, it might be clear about, okay, what do I do next? So sometimes it's just about making one good decision, sticking with that decision, sort of letting that decision play out and do all the hard work to let it play out and let go of needing to know what next because it's just not always obvious. And I know that sounds crazy because I talk about a long-term strategy. As I said, when you're 28 years old, it's impossible to come up with a 10-year plan, I think, for most people in that situation. The other thing around money is, there's been times where I've worried about money. I don't think worrying has ever helped. The more sleep I lose or the more I get stressed about it, I don't think it's actually changed the numbers. It's done anything. So, I think that's something that I sort of worked out in my 40s, early 40s. I'm never going to worry about money. At the end of the day, it's just a basic logical decision. Am I going to be okay? Can I afford the repayments? Am I willing to make these sacrifices? Yes or no? If it's yes, it is what it is. You're going to have tight periods. Don't worry about it. You'll get through it. If it's no, then it's no. Okay, you've overcommitted, and I think the worst thing you can do, the way I look at it is I make friends with worst case scenario. Worst case scenario for James is he comes, buys his house, borrows a huge amount of money, and 2 years down the track, it's not working out for him. And I think as long as you buy well, then hopefully you can go and sell that asset and not lose too much money. Hopefully not lose any money really and cover your costs. I think if you can do that, nothing ventured, nothing gained. It's not the end of the world, especially for a 28-year-old. They've only wasted a couple of years, still got a long runway left. Chances are though, probably is, it will work out okay. So don't look at it necessarily as, I've got this huge mortgage. What the hell am I going to do? Because $1.5 million mortgage, nearly 1.6, is a huge mortgage. It is a huge mortgage. But when I started the business, 25 years ago, it would be unheard of that mortgage almost. Like, at that stage, 700,000 was a huge mortgage. It all works out in the end. Time will do its thing. And you just need to really get through this sort of 5-year period. But if it is causing you a lot of stress, or if it is genuinely unaffordable and it's really putting pressure on lots of different things, then it might not be the right decision. And, maybe then you've got to course correct. Maybe if you've made a bad decision, that saying, if you find yourself digging a hole, stop digging. Well, if you do subsequently realize, no, that wasn't a smart decision given my financial situation, then you've got to unwind it. Forget about the ego thing. You've got to unwind it and correct it. So hopefully, James, that gives you a little bit of an idea kind of how to approach it, or at least how I would approach it, which I'm not saying is necessarily right. There could be many different ways, but good luck with it. I'm sure you'll get through it. And I'm sure, most importantly, in 10 years' time, you'll look back and go, that was a really good decision, and I'm glad I made it. So congratulations, James. And I might leave it there. And tomorrow's podcast, the title is How to Avoid Working Too Long and Underspending in Retirement. I'm not going to tell you any more than that. I think it's a good one. I got some good feedback from the people that review the blog before I write it, before I publish it, I should say. So hopefully you can tune in for that one. And until tomorrow, bye for now. And before you go, if you enjoyed this episode, please share it with someone that you think will get value from it. And if you have a moment, leave a rating or review on Apple Podcasts or Spotify, as it really helps more people find the show. If you have a question you'd like me to answer in the next Q&A episode, email it to questions@investopoly.com.au. And if you'd like to learn about my new book, Wealth by Design, which is out in a few months' time, head over to investopoly.com.au/book. The link is also in the show notes. And you can also register for the pre-order offer, which is an AI tool that you can use to get more personalized value out of this podcast. Thanks for listening.